What's up world? Michael EJ here, coming to you with another video in the field of finance, business, and life. And today I'd like to talk to you about the ETF movement that's happening in the financial markets right now and how it affects financial prices and what it means for you as an investor going forward. Now, it really comes from two parts. There's two main things that come with this ETF movement. And they're a great thing. To be honest, they are a great thing. They're semi-passive, semi-active. They lean a lot on academic research and finding factors that really matter in terms of investing in the stock market. It gives you a great way to get exposure to the stock market. Maybe you want some exposure to mid caps, small caps. You want exposure internationally. You don't want to be picking stocks out there. You don't know what's going on out there. So use an ETF. Buy into an ETF. They already have, based on their qualification or any kind of screening, already have it all laid out for you. It provides high diversification within one financial asset. This is the best thing. I mean, it's a great tool. I'll admit that it is a great tool. But in doing so, it's led to two things that's happening in the market. First thing is higher passive investment. So just put in the ETF and let it work out. Now for you and I, that might not be as big of a deal, but it's a big deal when institutional investors start to do it. When I say institutional investors, I mean the pension funds and the hedge funds and the sovereign wealth funds. These funds that control billions of dollars. There's even a couple of sovereign wealth funds in China control trillions of dollars. Trillion! Think about it. And you take a portion of that and you just throw it into a whole bunch of ETFs. Let's put in ETFs. It's just bumping up this kind of mix of semi-passive, semi-active investment. I mean, that's a big deal. I mean, that opens up a lot of opportunities. Combine that with decreased active management. Decreased active managers. I mean, they're just not doing as well. A lot of active managers aren't doing well. There's a decrease in funds going there. They're taking money out and they're putting money into ETFs. Big deal. So the ETF movement is increasing passive investment for institutional investors where the real money is at, where the real money is controlled. Combine that at a smaller scale with the DOL ruling, trying to get financial advisors to charge the straight fee at a percentage of assets under management for their clients. That doesn't sound like a big deal, and there's a lot of financial advisors that are already doing that. So from that standpoint, it's not that big of a deal. It becomes a bigger deal with this generation, millennials like myself and people older that are looking to invest more and more. They like ETFs, they like the simplification of things, and yet financial advisors won't be able to help them because the economics just aren't there with the DOL ruling. It used to be that with smaller accounts, you can get commission off of telling your clients to trade certain things, and usually with the fees that are charged, they're charged per trade. It sounds sketchy because a financial advisor could just tell you to do a whole bunch of trades, but it's not. It's not sketchy at all, and it works out best for smaller families, smaller individuals that might have $50,000, $100,000 to invest. About that much investable assets. Because you can only charge like 1% on that a year as a financial advisor on $100,000. They're only getting $1,000 from this one client. At least with commissions involved, you can bump that up to $3,000 or $4,000. You take a couple of those clients, combine it with the bigger clients in the millions, and you can service both. You can split your time evenly and make it happen. Now with this fee change, now all you gotta do is pay attention to the big fish. Only people you're worried about are people with millions. This leaves everybody behind. I mean, if you have $250,000 to invest, and you're struggling to find a financial advisor, that's a problem. That's a problem, and what you're going to do, you're going to take the money yourself and you're going to invest in the ETF, or you're going to go to a robo-advisor who uses tons of ETFs. I mean, this is kind of a big deal. So you combine both of those things. People with the lowest amount of money and the highest amount of money are both flowing into ETFs. It's changing the game for everything that's happening in the markets. And then this is mainly why even though the stock market valuations are a little bit high, prices just continue to go up, record highs are still continue to happen. In my opinion, this is primary reason number one. Now for you, as an investor, this is actually a good thing. This works out because the more passive investing that's happening, the more opportunities for you. If you love doing your research, if you love digging deeper into the numbers, this works out, especially at the small levels. If you're interested in small cap, mid cap stocks, even go all the way down to micro cap stocks, there's not a lot of ETF products there. ETFs usually incorporate the big names, market caps above 20 billion. If you go below that, and especially go under $1 billion, plenty of opportunity. Yeah, there's generic small cap funds out there, but it's not that many relative to the large caps. I mean, everybody loves dealing with the large caps. I mean, it's just easier to make money. With little to no equity research coverage on those smaller names, that just adds more opportunity. More opportunity for you to do your research. It also kind of shifts the paradigm in terms of investing styles. I believe from here on out, investors really need to consider growth prospects of a company and not as much on the valuation of a company. Now, I'm not saying it's not important to focus on the valuation of a company. Value is very important. It's very important. But, especially here in the U.S., value managers have been getting killed. They've been getting killed since the global financial crisis. Why are they getting killed? Because value is a mean reverting strategy. If you lean so much on the value of a company, then it's very high in mean reversion. As in, you need like a catalyst to get that mean reversion to happen. Usually that catalyst is volatility. When you have less volatility in the markets, either Federal Reserve isn't increasing interest rates or creating things, the economy isn't taking, the economy's moving slowly but still going up, and you have all this passive investment that's happening regardless of the fundamentals, value is just not going to be as good. It's just not going to work as well. That catalyst that's usually there for value investing isn't there like it used to be. So you got to focus a little bit on the growth side. Think more about not what the company's worth today, but what is it going to be worth tomorrow? You're paying for tomorrow anyway. So, I mean, this follows right through. I'll have another video on that. How do you think about that? How do you think about avoiding value traps? Even for companies that look great today, they might not be the best for tomorrow. So I'll have a video coming up later on that. But for now, that's kind of the focus. You gotta find more of a balance and lean more towards growth. So if you are into small caps, if you're more of a growth investor, this is good. This works out, especially if you like doing your homework. So that's all I have for today. Remember, you can join the ETF movement. It's not a bad movement. I'll say that much. It is not a bad movement, especially if you don't really want to dedicate that much time and attention to it. They're really cheap. I mean, they're not that expensive, and they're better than trying to pick stocks if you don't know what you're doing. So, I mean, I advise 90% of people to buy certain ETFs. Buy some small caps, mid caps, mix it up. But for those who want to do the research, those who want to dabble in small caps, and those who move a little bit towards growth, this is exactly what you need to happen. This is like a perfect storm. It's working out. So until next time, I'm Michael EJ, continuing to bring you different views in finance, business, and life. Until then, next time,